Hello, everyone. Tim Davis here, coming to you guys with another market update and another market review. And I'm just simply recording this one saying, brace yourselves, because the bear is about to ramp up again. And the bear is about to ramp up in a big way, possibly. Today is July the 14th. The time is, July the 14th, 2022. The time is now 3:46 a.m. prior to me heading out for my day. We'll start by looking at the overall breadth of the market. Um, Here's the Wall Street Journal highs and lows um, tool that I use quite often, just to take a look at the overall breadth of what's happening beneath the surface of the market. And it shows you, the highs and the lows for that particular time frame um, of the New York Stock Exchange and the NASDAQ. And for those of you guys who are new to follow me, if you want to get to this, the easiest way to get to this is by joining or coming to my Twitter page, which looks like this. God's Child Tim, and I have this pinned to the top of my page. The link pinned to the top of my page, and when you click on that link, it brings you to this page. And when you first arrive to this page, lets you know the time to the right. This says this last recording, or this last update was 4:15 p.m. on July 13th. Got two tabs here. One says NYSE, which is New York Stock Exchange. One says NASDAQ. Very first one is what it normally sets up on, and what it's showing you is the new 52-week highs versus the new 52-week lows. And when you look at this, pretty much what it's telling you in essence is where the market is leaning, how the market is leaning more bullish or more bearish. So here we see three new 52-week highs as of that print on yesterday. Just three. Look how many new 52-week lows for the New York Stock Exchange, 211. So you scroll down, you'll see that number. So three new highs, three new 52-week highs, 211 new 52-week lows. The bears are really sinking their teeth to this market. Look over to the NASDAQ. See 25 new 52-week highs. Scroll down. How many new 52-week lows? 305. So that shows you the overall breadth of the market, how the market is leaning. The bears are really sinking their teeth into this market. And I've been checking this, folks, for the past 6 months, and for the most part, it's always been skewed towards the overall breadth of the market is slowly but surely continuing to deteriorate, with the bears continuing to sink their teeth into this market. Now let's look at the SPXA 200R, which is the tool that tracks the over percentage of S&P 500 companies still trading above their 200-day moving average. And as of yesterday, it continues to deteriorate as well. We're now showing just 0.17, so 17% of S&P 500 companies are still trading above their 200-day moving average. For those of you guys who've been following me over the last year, I started blowing a horn when we were at 97, which was the highest we've seen in history. And eventually that was a topping pattern. So if I was to, let's go back here. So you'll see that 97% is when I said, okay, folks, be careful, because we are at this highest level that we were at in history. 97% of S&P 500 companies were above their 200-day moving average back in April of 2021. And since then, you see we deteriorated. This yellow line is my 20-period moving average. This percentage crossed below the yellow line and has been below the 20-period moving average since, and continuing to deteriorate. And you guys know my ultimate is that we are gonna more than likely bust this bubble, which is right at 0%. And I think we probably gonna go even lower. That's right about 0.4. I think we'll get to 0, honestly, eventually. 0 straight across the board. That's where we stand now. Looking at that weekly chart, here's a daily chart. Shows you how the percentages have been pretty much trying its best to keep its head above water. See, we've been pretty much in this tight range since the end of June. And if I was a bet man, I say this is about to roll over and start to test this So to test this level here, I think we're about to roll over and go back down to test that tenth of a percent. So right now we're 17%. I think we're going to go down and test 10% of S&P 500 companies, but at 200 moving average, and I think we'll probably break that. Maybe even go down to just 5% or maybe even 1% in very, very near future. So that's where we stand now. It's like we're just starting to continue to break back to the downside with that tool that shows the percentage of S&P 500 companies trading above that 200-day moving average. So that's also a negative on the markets. Take a look at the VIX futures. Here's our CBO VIX futures. And again, you see this is still showing overall movement that's trying to find a way to break out. This is a daily chart. And as you can see, as we get closer to this area here, as price action or the VIX is starting to be compressing in a corner, been creating these higher lows every time it pulls back over the past several months, creating these higher lows. And every time we hit the lower part of this trend line, creating these higher lows, we've been finding a bounce. Finding a bounce. So it looks like we are in store for the next bounce. And eventually one of these bounces is going to break us out of this range and continue to go higher. Could now be the time? Are there enough catalysts unfolding right now for it to be the time? There's plenty of catalysts. You see what happened with CPI data yesterday, 9.1, which was a shocker to all analysts. It was like something they were expecting a high print, but nobody was expecting to be that high. A 40-year high of the CPI print yesterday, folks. 40-year high. So that's enough right there to let you know inflation is still, not in control. And if you remember what the Fed said the last meeting, they said they would do anything, whatever it takes to get this inflation under control. So their main mandate is to get inflation under control. What did they do during the last meeting? They raised interest rates 75 basis points. And they even mentioned then that they would do whatever it takes in order to get this inflation under control. With another historic CPI print, the Fed meeting coming up in about another week, I think, I believe. Is it impossible to believe that the Fed would go 100 basis points? It is not impossible, folks. I heard one of the Fed speakers say this week that everything is on the table. So is it likely? Is there a possible chance that they can skip 75 basis points, go all the way up to 100? It is very, very possible. And do you think the markets are going to like that? Probably not. So the bears are really about to dig the teeth into this market, folks. All the writing is on the wall. With the dollar at all-time highs, you got there's just a lot going on that you see. You see copper is getting hit heavy. I told you guys that when Dr. Copper started to spill, there was another sign to tell you to watch below, because eventually our markets are going to follow. And here is Dr. Copper now approaching a level where it's going to want to bounce at this level. If not, that it's going to be detrimental for everything. It's just approaching this level, which is a long-term trend line that I drew from the COVID plunge. So that first trend line is the breaking point. That is a level that copper got to, could not break above the level, and then it just sold off gradually, or I should sharply, all the way down below $2. And then it started to rally. So copper is normally the leading indicator for our markets. Look at where we're at now, coming back to test that level. Could we see a bounce there? We could definitely see a bounce there. But I think the markets are going to follow first before we see that. And that means if copper sold off already, it's making that big plunge. our markets is no different. Let's take a look at the S&P E-minis. Here we are right here, right now. This is a weekly chart. And this line too, again, that is the line where we ran into some issues during the COVID highs, and we dropped like a rock. We hit that level was a level of resistance, hit the level and plunged all the way down to this level, which I think ultimately, I think we're going to test these COVID lows. That was the COVID lows of 2020. Again, this is the high point of 2020. We hit that level 2020 on the way up and fell and broke below the level. So now this level becomes a level of support. Will we hold this level of support? We have to see. I think we're definitely going to travel to this level of support in the very, very near future. The question is, will it hold? We'll probably get that answer over the next week or two. Will it hold and get that bounce? I think we're definitely going there. Here's a daily chart. And again, here's the 20-period moving average. And as you see every time, the 20-period moving average has been acting as a strong level of resistance. And every time we hit the 20-period moving average on the way up, we pull back a little. Here, pull back. Here, hovered around it a little bit for quite a bit and pull back. Hit it here, just pull back. Hit it here, just pull back. Hit it here, just pull back. Drop below it here and just continue to drop below it. You see the pattern. The question is, how far do we pull back below the 20-period moving average now? I think we're heading back to test this level. So again, there's a lot of data already out there that can help us get to this. That can help the bears push price action to this level. And I think there's also some more data that comes out on this Friday as well, if I'm not mistaken. I think it's retail sales data that may come out on Friday. And also we head into earnings season. So we have the first of the earnings coming out this morning, believe it or not. Banks are starting to report today. So we'll see how healthy the consumer is as far as wanting to borrow money. And the banks could be another telltale sign on what we can expect for earnings season. So a lot of stuff come up. We still have, again, earnings season just beginning. So there's still a lot of, fuel in the tank to sway markets in either direction. And I think more than likely, it's going to sway markets lower. That's my honest opinion. So again, watch for those earnings report early this morning. Look for, I want to say it's JP Morgan possibly, and one more bank, I think. And then tomorrow, I think we get a few more. Then next week, we go hot and heavy into earnings. And then also tomorrow morning, we also have another, this is retail sales data, I think it is, comes out at 8:30. So a lot of data coming down the pike that's going to, determine the direction of this overall market. CPI started it off. We got a big drop yesterday in the stock price and bounced right back, but only to a level of resistance yesterday. Look at the short-term action on S&P minis. If I was to switch this to a 4-hour chart, you see price really battled yesterday of keeping its head above water. So here's a 4-hour chart. We got that yesterday morning CPI. We got a big drop, and then look what price did. Push price right back up, only back to that 20-period moving average. Look what it did. Pushed it right back down. And that's what we're doing now. We had right back down after we pulled back yesterday, rally right back up to the 20-period moving average. And I told you, even on the 4-hour chart, it's acting as a strong level of resistance. Look at that. Pushing right back down. So there's a lot of weakness in this market, folks. Come back to our daily chart. Take a look at, let's take a look at a monthly chart. How are we looking on a monthly? Look at that. The monthly is starting to dig. It's getting ready to dig, folks. What I'm looking to see eventually on this monthly chart is a break. Again, I'm looking for a break. I'm looking for a major breakdown below this level of support. And then I'm looking for us to start to see red bars start to form on a T10 squeeze on a monthly chart, which would be a big time negative. So, and then RSI, for RSI to start to drop below the 30 level, 30 line of on this monthly chart. So folks, this market is extremely weak and vulnerable to much more downside. This bear market is really probably about to sink its teeth into this market, and a recession that everybody is saying it's not here yet. I think it's already here, and I think folks are going to be, these economists are going to be really surprised that we've been in recession already, probably for a bit. Okay. Here is our NASDAQ futures. Again, no different. Right back at its 20-period moving average, and like it is starting to pull back even further. And Dow Jones futures starting to pull back even further as well, after rallying back up to that 20-period and now starting to pull back. So folks, markets do not look healthy. Again, I've been on the short side for a while, staying on the short side for the most part. And just, enjoying the downside of this market. Again, you can make just as much money on the upside as you can on the downside if you know how to play in this market. One last look at the VIX futures before I end this brace yourselves video, because this brace yourselves is probably really getting ready to ramp up. So this VIX, folks, is going to be a telltale sign. Again, I keep harping on where the VIX is now. Right at the level of support. It's still hovering around this level. We're still below 28, still below 30. If VIX get a sustainable above 30, folks, I think we are going to be headed back up towards another test of the upper trend line, and I think we could possibly break that before this month's out. So watch the VIX like a hawk. The VIX is already showing a lot of positive divergence. We got the full stochastics and the VIX starting to turn up. The Williams percentage starting to hinge higher. RSI starting to make an attempt to hinge higher, starting to turn up. So watch that VIX right at 27. You see that pop above 30. I don't think we're coming back down in the near term. We can get above 30 on the VIX futures. So keep that in mind, and be vigilant, be ready, and continue to be nimble in this market. And if you know how to trade the downside, sit back and relax and let the good times roll. All right, catch you guys on the next video.